And that's why there will be a rush to gold. And that's why I'm not concerned about the price volatility in gold. It's more like price volatility of fiat currencies. And that's why I'm holding on to it. So what I think, as I said, to sum up, I think we're going to see an increase in the proportion that Chinese insurance companies can invest, maybe up to 5%, maybe even more. Maybe in a decade's time, it will be like 10, 15%. And that will basically bring back gold from the FT's, denigration, right? The FT, they'll have to eat humble pie one of these days, hopefully.
Mario Innecco, a seasoned market analyst who warns of an impending storm as the roots of the global financial system start to crumble. Innecco, a seasoned trader with decades of experience in the city of London, feels that the world is quietly moving back toward genuine money, such as gold and silver, and that trust in fiat money is diminishing. Innecco has been warning about central bank manipulation, inflation, and government debt for years, referring to the current system as a Ponzi scheme built on confidence. However, that confidence is now waning. Innecco sees the start of a monetary reset in which physical assets reclaim their ancient importance, as central banks, particularly in the East, hoard gold at record proportions. In a recent update, he cited significant gold accumulation by Russia and China, as well as a rise in mistrust of the dollar-based economy in the United States. In 2024 alone, central banks added over 1,000 tons of gold, and Innecco thinks this trend is just going to get faster. Please remember to like this video, subscribe to the channel, and enable post notifications before we delve further. Thank you, and enjoy the video.
What are we going to talk about today? Well, we're going to talk about China and how, in my opinion, China is transforming the gold market. And I'm going to reference this really quickly here. It's an editorial. A lot of you, or most of you, know about this, that I cut it out back in 2004 from the FT. I found it so outrageous that I laminated it. At the time, we didn't really have iPhones, so we still read the physical paper. And in this editorial from April 16th, 2004, the FT wrote, going gold. So there you go, going gold. I even wrote the date here and where gold was. Well, it was at $400 an ounce. The direction is clear. Gold is on its way out as an investment and as a reserve asset. 3 cheers for that. So the reason I'm showing this is it shows how our mainstream press, financial press, whatever press, they're bought and paid for by the powers that be, by the bankers who don't want the public to protect themselves from fiat currency inflation. But the Chinese, for some reason, they want the public to protect themselves. They want the Chinese to protect their savings, which is ironic because I thought they're supposed to be the baddies, the communists, right? The authoritarians. But anyway, I'm going to put this right here on the screen right now. And you can pause, do a screenshot, and read it yourself. So why do I think China then could transform the gold market? Well, if you've been listening to me for the last few years, you know that I've been covering the fact that central banks, especially China, Russia, Poland, India, a lot of the global south countries have been buying gold, net buying of gold, hand over fist since 2022. And Russia and China have been buying, well, for the last couple of decades, adding on to their reserves. And recently, in February, China announced this, and this is from the World Gold Council's website, and this is dated February 19th, 2025. China's insurance funds inject new vitality into global and domestic gold markets. So let's go through the story. You probably have heard of it. And then I'm going to give you my opinion on it and what might happen. It's going to be a speculative exercise. And we're going to look at Japan as well, because their insurance companies are having trouble as well. And we'll see why. So it says here, the National Financial Regulatory Administration of China has issued the notice on launching a pilot program for insurance funds to invest in gold, hereinafter referred to as the notice, allowing 10 insurance companies to invest in gold effective immediately upon the release of the notice on February 7th. Well, when you speak to the average person out there, or you speak even to financial advisors, they say, oh, no, you shouldn't invest in gold. It's too risky. It's a commodity, right? But let's continue reading this.
While many other financial assets are struggling, the value of gold has been increasing quickly. Similar trends were observed during the global financial crisis of 2008 and the COVID-19 epidemic. A significant distinction exists this time, though, in that central banks and significant investors are spearheading the movement. Many central banks, particularly those in emerging nations, have begun to worry since Russia launched its full-scale invasion of Ukraine and the G7 responded with extensive sanctions. They worry about getting caught up in a global crisis or becoming the next target of financial restrictions. In order to safeguard their reserves, they have been purchasing gold at record prices. According to seasoned analyst Mario Innecco, this would prompt Japan to introduce a new law, possibly a trial program, that permits insurance firms to make gold investments. Mario claims that if that occurs, it might swiftly spread to other nations, such as the UK and Western economies. Now, let's dive back and hear what he has to say.
And that's why I personally have been trying to acquire as much gold and silver for a while now, and many of you have asked me how to do it. Well, I've got a couple of affiliates, and if you want to look them up, they're below in the description. Miles Franklin in the US and Golden Investments in the UK. And if you do contact them, make sure you tell them that Mario or Innecco64 sent you. Anyway, let's continue. Gold's low correlation, gold's low correlation with other assets and its stable long-term returns make it a high-quality, non-traditional asset for insurance portfolios. Incorporating gold into these portfolios brings the potential for lower volatility, high returns, and an optimized risk-return profile, preserving or even enhancing the asset value. Furthermore, amid rising global uncertainties, gold's well-established role as a hedge against risk. We've seen recently that Japanese government bonds have been dropping quite a lot, and that's really important in terms of the insurance industry, because insurance companies they hold government bonds because they've been conditioned to think that that government bonds are safe and they are stable. And they're not volatile, but they're anything but now, the JGBs, because they were artificially kept very high in terms of price and very low in terms of yield for decades by the Bank of Japan and its money printing or QE exercise. But now, with interest rates all around the world having gone up, Japan has to allow rates to go up. It can't be as aggressive. And Japanese government bonds have gone from yielding negative, even up to the 40-year, to now being up to like 3.5%, for example, the 40-year. The 10-year is approaching 2%. Yes, it's still at 1.5%, but I won't be surprised if it's up to 2% by next year. So what happens is Japanese insurance companies' assets, their unrealized losses are piling up, because when yields go up, bond prices go down. So that's very serious. Prior to 2022, it was plain sailing because yields, interest rates kept going lower, the value of bonds kept going up, and it wasn't a problem. But now it's all reversing. So my speculation here is that we will see soon Japan come out with their own pilot program and allow insurance companies in Japan to start investing in gold. And I think it's going to spread like wildfire, even for insurance companies here in the UK and elsewhere in the West, because the bull market in bonds is over. Yes, there's still a lot of people out there who are in denial, in my opinion. Yes, we can have counter trend rallies and counter trend drops in yields, counter trend rallies in price of bonds, and and counter trend drops in yields, but that's all it is, counter trend. Longer term, yields are going to go a lot higher, and that's why there will be a rush to gold. And that's why I'm not concerned about the price volatility in gold. It's more like price volatility of fiat currencies, and that's why I'm holding on to it. So what I think, as I said, to sum up, I think we're going to see an increase in the proportion that Chinese insurance companies can invest, maybe up to 5%, maybe even more. Maybe in a decade's time, it will be like 10, 15%. And that will basically bring back gold from the FT's, denigration, right? The FT, they'll have to eat humble pie one of these days, hopefully.
Mario Innecco emphasized the significance of the increasing volatility in Japan's government bond market for the global financial system, as well as for Japan. Japanese government bonds were regarded as extremely safe and low-risk investments for many years. For this reason, insurance companies have made significant investments in them both in Japan and beyond. Because Japan's central bank had maintained interest rates close to zero or even negative for many years by aggressive money printing and quantitative easing, these institutions were trained to view government bonds as safe and stable. Now, however, things are shifting. Japan is under pressure to allow its own interest rates to climb in tandem with global interest rate increases aimed at curbing inflation. Bond prices also decrease as interest rates rise. Bonds function in this way, they go in opposing directions. Therefore, significant unrealized losses on their portfolios are currently being faced by insurance companies that hold significant amounts of Japanese government bonds. To put it another way, their safe investments are becoming liabilities. In the short term, the price of gold may seem unpredictable, but what we're really witnessing is the volatility of fiat currencies, not gold itself, he continues. He believes that while currencies like the dollar, the euro, and even the yen are depreciating, gold is just maintaining its ground. For this reason, Mario claims he is holding on to gold for dear life and is unconcerned about its fluctuations in value. Don't forget to like, subscribe, and enable notifications for more valuable content, and as always, happy investing.